The financial ratio analysis of Loblaw Companies Limited using the consolidated financial statements for the 2021 and 2020 fiscal years. Our team includes Matthew Defoe, Keisha Mitchell, Nordwing Sanchez, Barb Rolfe, Mitch Warkin, and Kristen Whitford. Loblaw Companies Limited, commonly known as Loblaws, is a collective of companies that was founded in Canada in 1919. Over the past 100 years, they have grown substantially, becoming one of Canada's most innovative grocery retailers, with over 2,400 locations in the country. Through our presentation, we will be doing a fiscal year comparison for the company's 2021 and 2020 years, looking at the differences in the company's liquidity, profitability, and solvency to determine if the company's financial health is positive or negative. The current ratio is the first calculation we did to determine if Loblaws is capable of turning their assets into cash quickly. The calculation for this is current assets divided by current liabilities and is used as a measurement of liquidity. Loblaw's current ratio, when calculated for 2021, provided a result of 1.37 to 1, where the 2020 calculation showed a ratio of 1.32 to 1. The calculations for both years indicate that Loblaw's current assets are liquid, as the ratios in both cases are greater than 1. The current ratio for 2021 increased by 0.05 over the previous year, meaning that Loblaw's assets became slightly more liquid than they were in 2020. We calculated Loblaw's working capital by subtracting the company's current liabilities from its current assets to determine if it's capable of paying its short-term debts that could require being paid in full within the year. This calculation is also used to help determine the liquidity of the company. Our calculations of Loblaw's working capital gives results of $3,441 million for 2021 and $2,779 million for 2020. The working capital for both years are positive, indicating that Loblaws is capable of meeting their short-term debt obligations, as well as showing positive liquidity for the company. We also see a working capital increase of $662 million over the previous year. We calculated Loblaw's net profit margin by dividing the company's net profit by its revenues. This value shows the company's earnings after all other expenses and is used to determine how profitable the company is. Loblaw's net profit margin, when calculated for 2021, gave a result of 3.7%, where the 2020 calculation showed a result of 2.3%. These calculations indicate that Loblaw's net profit margins for both years, once again, are positive. From this, we can conclude that Loblaw's is profitable. Even if the profit margin appears small, the company's net profit margin also showed an increase of 1.7% from 2020 to 2021. We calculated Loblaw's return on equity, ROE, by dividing the company's net income by its total shareholder equity. The ROE measures how effective Loblaw's is at converting its assets into profits and is another way of gauging the company's profitability. Investors will often look at a company's ROE to determine how desirable it is for investing in. Loblaw's return on equity was calculated to be 17.07% for 2021 and 10.85% for 2020. These calculations indicate that Loblaw's return on equity for both years, once again, are positive. From this, we can conclude that Loblaw's is capable of making profit off of its assets, adding another indicator of overall company profitability. The company's ROE also showed an increase of 6.22% from 2020 to 2021. We calculated Loblaw's debt-to-asset ratio by dividing the company's total debt or liabilities by their total assets. We use the debt-to-asset ratio to determine the percentage of assets that are paid for by financing or credit. This calculation is used to gauge solvency. Loblaw's debt-to-asset ratio was calculated to be 67.94% for 2021 and 69% for 2020. These calculations indicate that Loblaw's debt-to-asset ratio for 2021 decreased 1.06% from 2020. From this, we can conclude that Loblaws has improved their solvency from 2020 to 2021, meaning that the percentage that the company had their assets being paid for by financing or loans has decreased. In review, we can see that from 2020 to 2021, Loblaw's current ratio improved by 0.05, and its working capital increased by $662 million. This shows that Loblaws is liquid. In the same time period, its net profit margin increased by 1.4%, and its return on equity increased by 6.22%, showing us that Loblaws is profitable. And finally, its debt-to-asset ratio decreased by 1.06%, showing us the company has improved its solvency. In conclusion, the data shows that in both the 2020 and 2021 fiscal years, Loblaws had good financial health. It also shows that from 2020 to 2021, Loblaw's financial health improved in their overall liquidity and profitability. They also managed to improve their solvency with a debt-to-asset reduction. The COVID-19 pandemic that affected many companies worldwide negatively seems to have had no drastic effect on this organization's finances. This project really made us realize there is a whole new way to think about money.